for the decline. Okay, earlier today, JP Morgan CEO Jamie Dimon shed a little more light on the trading loss known as the London whale debacle. Dimon says the company lost a total of $5.8 billion. That's so far. So is the worst over for JP Morgan? Joining me now is Peter Schiff from Euro Pacific Capital. We also have Dennis Kelleher from Better Markets Incorporated. Gentlemen, thanks so much for joining me. Peter, I'm going to start with you because you're on remote. You're on a little bit of a disadvantage there, so we'll let you go first. What did you think about the call today, and what did you think about that number? So the total now so far is 5.8. They're saying that we could see another 1.7 billion in the third quarter. Do you think that a total of 7.5 is the real number? Does it get bigger? Does that number make you nervous?
Well, we'll never know until the position is fully closed out. I knew the minute that they disclosed the unrealized losses that they were going to get a lot bigger, especially when the traders smell blood. When they know what their position is, they're going to trade against it. And so it gets more difficult once everybody knows your hand. So I've always expected the losses to get bigger. But clearly, if you put them in the scheme of things, it's a trade. Not all trades are profitable. They had other trades that more than offset this. And, of course, somebody took the other side of that losing trade. For every dollar that J.P. Morgan lost, somebody made that money. It's a zero-sum game. So I think we're certainly overreacting to it from a regulatory position.
But from Dennis, what do you think about this? Because, I mean, it's still a huge number, 7.5 billion. And today we learned that, some of the traders may have been hiding the losses. That was a revelation.
Right. Actually, from a regulatory perspective, it's very significant. It's not the dollar loss. Let's remember, in the years before the financial crash in 2008, banks reported, fabulous billion-dollar revenue quarter over quarter, but we found out most of it was fraudulent in many ways, and from toxic securities. So, and the
fraudulent's a strong word.
Well, the problem is that all those profits were wiped out in the financial crisis. So illusory was probably the better word, where you think you got big profits and you really don't. So the mere fact of profits doesn't tell you much. There were three interesting disclosures today.
Okay.
One was that they're afraid that they reported that the trades were not priced at the right level in good faith, and therefore there may in fact have been fraud going on here. That was important disclosure. The second important disclosure was J.P. Morgan Chase disclosed that they had material weaknesses in their controls, which is almost never found in a corporation, a public corporation, and certainly not a big corporation, and that's cause for concern. And then the third thing is that the loss has grown from roughly 3 million to almost 6 million, and it may go to 8 million. So from a regulatory point of view...
You mean billion.
I'm sorry, billion, yes, thank you.
If only it were just billion.
But from a regulatory point of view, it's not the dollar amount, it's what happens inside a bank that's backed up by taxpayers. So while it is true that somebody else made some money and somebody lost money, at the end of the day, taxpayers stand behind the too big to fail banks, not just JP Morgan Chase.
And here's the problem,
Peter.
though. See, taxpayers shouldn't be standing behind these banks. That's the larger issue here. There should be no taxpayer guarantees behind these banks. What we need is capitalism in the banking industry, not socialism. But I think an even bigger point, I think this loss is going to be small in the scheme of things. Wait till you see what happens to J.P. Morgan and all the other big banks when interest rates finally rise. I think the losses are going to dwarf this loss. You're talking about the illusory profits they had. I was out front before the financial crisis. I was on this and many other networks predicting a collapse in the banks because I knew how they were exposed to the mortgage market, and I realized what was going to happen in advance. I think banks are even more vulnerable now. In fact, I think all the major banks that were bailed out with the TARP are going to need to be bailed out again. I think they're even in worse shape because of interest rate exposure. Once the Fed loses control of rates and they're forced up, I think all these big banks are so over-leveraged, their balance sheets are loaded up with long-term, low-yielding government bonds,
Peter,
mortgages.
I hear you, but in the meantime, let's focus on some of the results from this earnings report, though. I mean, if you look inside of it, you look at the mortgage business, delivered nice results. I mean, a big improvement there since it's gone under the watch of Frank Bisignano. There's a lot of improvement there. I mean, there was a lot of good news in this report that gets dwarfed by this loss. Go ahead.
Well, but if you understand long-term, look, if you want to trade the financials because you think you're nimble enough, but nobody should own these stocks as a long-term investment. They're all going to implode. The profits they're making today are just sowing the seeds for future losses. Yeah, they might be making money on the mortgage market today, but that's because the Fed funds rate is at 0. They can make money on 3% and 4% mortgiges. What happens when the Fed funds is 5% or 7%, and they're drowning in these mortgages?
Hang on, Dennis. What do you think about that?
Peter's right in terms of the interest rates only have one way to go. Let's face it, they're at zero right now for all intents and purposes for these too big to fail banks. So when they go up, they're going to get caught in the whipsaw from low rates to higher rates. But that's multiple years down the road, probably based on what the Fed is saying. So while that's coming, the real issue is how do we deal with too big to fail banks? And this is the biggest of them all. And one of the things we really need to do is before we get to the interest rate hit is how they're regulated in a way so that the most risky activities that create the biggest losses.
I don't know if more regulation is the answer. I think not letting them be too big to fail is the answer. They should be allowed to fail.
If we could do that, we tried to do that in the Congress during Dodd-Frank, and we weren't allowed to do that primarily because of the lobbying going on to prevent it from happening. But there was in fact, the amendment to do that got only 33 votes in the Senate. But that's the real solution. But until you get there, you have to limit their activities.
Gentlemen, we have to have this discussion again another time. Thanks to both of you for joining us. We got to move on.